Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds. This is a review of markets for September 2022. A terrible month for asset markets in the whole across the September month. Coming out of Jackson Hole meeting, which was at the end of August, we did have much more hawkish central banks speak, realising that they really do need to move financial conditions against consumers. They need lower equities, they need wider credit spreads, they need higher bond yields in order to break the back of inflation, to bring inflation back to expectation sometime in the early to middle part of next year. That generated a very large bond market sell-off. It's obviously moved across into equity markets and other markets. And really only one of the places to hide has been US dollar cash position, with the US dollar doing extremely well. We continue to believe that whilst this occurs, and obviously the bond markets have a huge amount priced in terms of their expectations of central bank policy movement, that the worst is still to come, sadly. We are moving interest rates so quickly at the moment that the lag effect of monetary policy is not really evident in the economy yet. It's not changing consumer behaviours materially in order to lower those inflation expectations. Having said that, we do absolutely expect that we've been past peak inflation, barring a more exogenous energy shock, because energy is the big swing factor. And that's why we look to this European winter period to see what might occur with regard to Russian oil and gas and how that might work. We know that that's a perilous situation that's badly set up, but that really is very important as to what the inflation pathway will be. From where we are at the moment, knowing that we've just had two very weak month-on-month inflation prints driven by energy at 0.1 and 0 in the United States, inflation does moderate by March to June of next year back to around that 4% mark. And the reason that 4% mark is very important is the expected Federal Reserve funds rate is above 4% at that time. And historically, it's taken the Federal Reserve funds rate to get above the year-on-year inflation rate to really break the inflation back and bring that back down into check. The major problem that we're starting to see, though, is that markets are simply not going to be able to hang on that long. We've already had material issues. It was in the United Kingdom in the last weeks of September, and the last week in particular. And the absurdity of the situation from a policy point of view is really incredibly pronounced. The Bank of England announced a quantitative tightening program on the Thursday. They released a mini budget suggesting they wanted to cut the top tax rate on the Friday, and they were doing emergency QE by the following Tuesday and Wednesday, as the solvency of some of the pension system, which is allowed to use leverage in its asset liability matching, came into question after vast moves in UK asset prices, both bonds, currencies, and equities. So we are getting to the stage of this episode where clearly, having had an inflation issue, a material issue after lockdowns and overstimulus and these types of things, turbocharged by the geopolitics of the Russia-Ukraine situation, we are now moving away from that in the part to a more of a credit and liquidity type of issue where margin calls and these types of things can cause markets to do unusual things. If we think about the closing valuations of the Australian government bond market at the end of September and run it through a scenario analysis, which we've presented to folks previously, we've done a lot of the mathematical calculations to look at the expected returns on, say, a 12-month go forward. Now, on our really horrible outcome for asset markets, in which we still have very high inflation expectations, the assumption there is that the RBA cash rate could go north of 5% in order to crush that inflation. But interestingly, from this point on, bond returns would be somewhere in around the negative 2% at an index-only level, remembering it's illegal for me to forecast our fund returns. Conversely, if things were to go really well, right at the other end of the normal distribution of scenarios, and bond markets were to perform with less interest rate hikes required, well, then obviously returns could be quite pronounced as we would capture a lot of the ground that's been given up over the course of this year in expectation of needing to take the cash rate so substantially higher. Now, I think we can all see, as we look at these episodes in the UK, and we've seen the way that the Bank of Japan has had to intervene in their currency. The Bank of Korea has also been intervening. The ECB have never stopped intervening. That we are getting much closer to this breaking point where something will go wrong that is systemic in nature that will require policy to pivot. Now, that pivot is not to say we're going to turn around and cut interest rates and do quantitative easing. Clearly, much higher inflation outcomes as a result of a material energy shortage in the most is a real big problem for central banks. But if they just pause in terms of their rate hiking cycle and jamming their foot really hard on the brakes of the economy, then clearly markets are going to like that, and it will provide some level of certainty and help to bring volatility down. We have a lot of work that we've done around that inflation pathway and what it might look like under differing scenarios. Clearly, there are assumptions on what the averages of the month-on-month inflation outcomes will be. We know things like new cars, used cars, shipping and freight, a lot of goods, these prices have been coming off for quite some time. We know that on the services side of the economy, inflation is proving to be much stickier. The obvious one there is rent, but there is some suggestions that there are moderations in some of the bigger capital cities, certainly in the United States. But that huge swing factor remains the energy component. Biden, Xi, Putin, OPEC, a few very powerful folks control the outcomes, in what are the puppet strings of whatever is going on with that geopolitics at this point. The Strategic Petroleum Reserve in the United States does need to be restocked at some point. Is that after the summer driving season in the United States into lower consumer demand? Maybe Biden's the best commodities trader we've seen in quite some time, having released it all well above $100 or a vast majority at the early part of the Russia-Ukraine conflict in order to try and drive down those inflation outcomes. We still have midterm elections to deal with in the United States coming into the fourth quarter, but we've got to get through October first. And October has obviously been a very difficult month for markets, in years gone by. As we come into the back part of this year, we have to expect that the economy continues to weaken as the full effect of the monetary tightening that we've gone through, the biggest hiking cycles we've seen since 1994 on the largest debt burdens we've had, obviously has a very pronounced impact and will lower discretionary spending in the economy. But it really hasn't turned up in full yet. It's all happened so quickly that it hasn't been highly observable, but we absolutely believe that is going to come. We do think that there are likely to be other systemic issues. The obvious one would be a large corporate that would fail to roll forward an existing debt obligation that could cause a bit of a seizure in the corporate credit markets. That would be very bad for corporate spreads, and it would obviously seize up, in terms of risk markets. And we saw that in the end of 2018. We've talked about that many times, the domino effect of the way that this can play out, particularly as the funding and refinancing rates are now so substantially higher than most people were expecting, and substantially higher than we've seen in many, many years. The last time the United States 10-year Treasury bond traded at a 4% yield was 2010, and the S&P was trading at 1,300 at that time. Now, obviously, they're not apples for apples in any respect. A lot of those older legacy businesses have left the index. A lot of new and fantastic businesses have entered with much higher growth and earnings. But it's an interesting point just to see that there is still some seemingly a status quo expectation that once we get through this big inflation rise and fall which we're going through, things can get back to a 2019 normal. That might not be the case. We might have more inflation around as a result of these energy shortages and the like for a little while longer, and certainly some amplitude to the way that the rise in inflation and then the fall and then the re-rise and then the fall will play out. Certainly the fastest way to get to a disinflationary environment is to have rampant inflation first. And of course, once you have very disinflationary data, as the sample rotation continues to occur, you're dropping old historical data and you're loading in new data, then it can re-accelerate, which is why central banks are going to have to be so careful about re-stimulating economies too quickly, because they can spike inflation higher if they're not careful. So we expect that yields, which have moved much higher of late. They do look incredibly attractive on a historical basis. As I said, in our own scenario analysis, which we're very happy to share with clients, we've got an expectation of yields between 5 and 3%. I dare say that if we try and get 10-year yields to 5%, we will have huge systemic issues in financial markets if they were to stay there for any period of time. But of course, it's possible. And so we'll scenario analysis for that. But because the income set is now so heavily restacked in terms of the yield that is in bond market portfolios, obviously the total return damage is incredibly slight from here on. And I dare say that a negative 2% return in a bond product, whilst unwelcome, could be an awful lot better than some other asset classes should we go through that incredibly stressful phase. So in many respects, bonds have become very, very investable again for those that had an underweight or a neutral duration allocation. And certainly as we think about liquidity and credit quality into a much more likely recessionary 2023, that should really come to the fore. Thank you very much.